Hi everyone, welcome to today's lesson. We are doing a weekly lesson series for the Strategic Day Trader Room members, and I'm broadcasting the Tuesday night lessons to social media. For those tuning in, welcome. I am Sami Abusaad, Director of Education at T3 Live and lead moderator of the Strategic Day Trader. Last week we started a three-topic lesson or a three video series on where to buy or sell anything. We talked about the three main areas being the minor support, rising 20 if you're looking long, and the 40-60% retracement level. We covered already minor support, minor resistance. We covered the rising, declining 20 period moving average, and today we're going to talk about the third part or the third area, which is the 40-60% retracement level. Before we start though, just want to share this standard required disclaimer with you to let you know that trading is risky and that whatever we discuss today is for educational purposes only. Okay, so with that, keep that in mind. With that in mind, let's get back to our lesson. Again, last time we talked about the moving averages. We said the main moving average that we're most interested in is the 20 period moving average. I actually got an email about the 40 period moving average, and somebody said, why do you use the 40 instead of the 50, which is a lot more prevalent or used more, a lot more commonly used than the 40? And that's a good question, because usually I want to use what the moving average that everybody's looking at, because we trade people, we don't trade stocks. When you're taking a trade, somebody's taking the other side. So it behooves you to know what they're looking at and what they're seeing. So, and if the 50 period moving average is more commonly used than the 40, one should look at using the 50. But the reason why the 50 is a better moving average to use when coupled with the 20 is because the 40, did I say the 50? The reason why the 40 is a better moving average to use when coupled with the 20 rather than the 50 is because the 40 is double the 20. So if you get the railroad tracks between the 20 and the 40 like so, and the distance between them basically stays even, about the same, then you have what we call usually a power trend, and that's the kind of trend that is sustainable, that will go on and on and on, and that usually looks really good on multiple time frames. So you don't even have to look at the larger moving out, the larger time frame. So if you were trading the 5-minute chart and you had railroad tracks on it, it will usually be good also on the 15 and the 2-minute time frames. So that's why we like to use the 40, because it's double the 20. Okay, and it gives us those nice railroad tracks. When it does, close your eyes and play that stock, buy it. Where do you buy it? This is what we're talking about today and what we've been talking about it the last couple of weeks. You buy it at when it pulls back to minor support and or the rising 20 and or when it's in the 40-60% retracement range. Now, that's the kind of pattern that we look for. There are many patterns that we do, actually not a whole lot. Basically, if you think about it, stocks can correct either through time by going sideways, in which case you get the breakout play off the rising 20, or they can correct through price by pulling back. So in reality, there are really only two patterns in existence. There is a third one, which is when stocks go climactic, but that's, you buy that due to exhaustion of selling. But that's all there is. Can you think of a single other pattern that is not a variable, that's not a subset of the pullback pattern or the breakout pattern? I can't think of any. So there are really almost only two patterns in existence. Again, three, with climactics being the third. And that's because stocks can correct either through time by going sideways or through price by pulling back. So when it pulls back to the rising 20, I want to look to buy it. Okay. Now, if it pulls back to the 20 and minor support, oh my God. If it pulls back to the 20 and minor support, and it has railroad tracks between the 20 and the 40, see it? Then that's the kind of thing that all pullbacks are buyable. All breakouts are buyable also if you get a base breakout like we got here. Not one should escape your attention. Not one. When you get a pullback to the rising 20 to minor support. The beautiful thing is, I'm not going to cover every slide from last week. Feel free to check out last week's lesson. The beautiful thing is, the same to the downside. The beautiful thing is the 20 and minor resistance or minor support, that's minor resistance, what used to be support in a downtrend becomes resistance on a retracement, often, usually coincides with the declining 20. So if you have a 20 period moving average, this is why it's really nice to have a 20 period moving average. I know it's subjective, it's a line on the chart, but it's very nice because it often coincides with resistance. Perfect. Okay, does that make sense? Often coincides with resistance. On the way down, the way up, doesn't matter. What was resistance in an uptrend becomes support. This becomes support on a pullback. See it? And where was the stock at? Right at the rising 20. Perfect. That's the kind of play you want to take. You want to play long anytime you get it. Right? At the rising 20. And where's minor support? Well, here it is. What was resistance becomes support on a pullback. Now, it doesn't have to touch it. It could be just above it too. Because as we explained last week, traders get a little anxious if they were short and the stock was going against them. They start, if you're down 4,000, down 3, down 2, down 500, down 200, they say, what the heck, that's as good as break even. They get out before it even reaches their break even point, which is the prior pivot top. Okay, so minor support exists in uptrends, and it's at or near or just above the area that the prior resistance area. That's minor support. In a downtrend, minor support is what used to be minor resistance. Minor support doesn't exist in a downtrend. Minor resistance is what was support becomes resistance on a retracement. So at or near or below, just below the prior pivot low. Okay. So we talked about minor support. We talked about the 20 last time. Today, we're going to talk about the retracement percentage. Okay. And just retracements in general. We've all heard, while there are numerous retracement levels, we've all heard about Fibonacci, right? That have gained mass popularity over the years. We have our traders focus primarily on the 50% retracement level, which is by far the most prevalent of them all. But because it is dangerous to demand or require that the market be too precise, we focus on the range or zone that covers the 40 to 60% area, rather than pinpoint the 50% spot. Okay. You can read this too. The concept of retracements is another important key that helps unlock the door to predicting where price movements are likely to end. It also serves as an excellent way to pick low-risk entry points. Retracements allow the T3 trader to know where price turns might occur. They also serve as a way to measure just how strong the preceding move was and just how strong the next move is likely to be. Because the deeper the retracement, the weaker the stock, right? That's how you can measure the strength of the stock, by how deep it pulls back. They prevent the trader from projecting his hopes and fears into his expectations of the next move. In other words, retracements help keep the trader objective. Without being objective, the likelihood of you losing money is 100%. Okay? Is basically 100%. So now we talk about the different retracement levels, and I'm going to talk about the different levels with you. The most important one of them is the halfway mark. So if you have a stock that goes from 36 to 40, pulls back to 38, that's 50%. Anywhere actually between in the 40 to 60% retracement level, if you get a buy setup, if you get a pattern, that buy setup, that increases the odds. That buy setup has higher odds of working if it comes from that 40 to 60% range. I'm going to put it all together for you in the next few minutes, so just stick around. If you have a stock that drops from 40 to 36, rallies to 38, that's in the 40 to 60% retracement level. That gets 10 extra points as a play. It has higher odds of working. Now, this is the beautiful thing, is that on many occasions, on most occasions, the 40-60% retracement level will coincide with minor support and the rising 20. If and when this happens, the potential potency and reliability of the play rises. The same is true in reverse for stocks in a downtrend. So check this out. So from here, well, you can say from here to here is 100%. From here to there is about 40%. So that's a good buy setup. From here to there is 100%. From here all the way down to here, that's about 40, let's say. Also at the rising 20 and minor support. See it? From here to here is 100%. From here to there is about 50%. Also at minor support and the rising 20. Beautiful. Play it long. You also have the railroad tracks. You also have a 45-degree 20 and an uptrend that's going from the bottom left corner to the upper right corner of the chart. That is the kind of trend that when you see, you just have to play. You just have to. Where? At or near the rising 20. In this case, it would also be in the 40-60% retracement level. It would also be at minor support. At minor support. Okay? So here's another example where the stock had the railroad tracks, but also had a retracement to the rising 20, to minor support, and from here to there is 100%, from here to here is about 50%. So perfect all around. Okay, perfect all around. Before I finish, because I want to put it all together for you, as I said, remember that retracements have, especially Fibonacci retracement levels, have gained mass popularity over the years. And what are the Fibonacci retracement levels? I mean, you can Google them. It's like 23.6. In fact, I'm 38.7 or something like this. In fact, I'm going to Google them right now. What are Fibonacci numbers? Okay, so here they are, or retracement, not numbers. Retracement levels. I think it's 23.6, 38 point something, and then I'm not finding them. I just Googled them here. Okay, here they are: 23.6, 38.2, 50%, 61.8, and 100%. So, and a lot of platforms these days have the Fibonacci tool. So you basically you draw, you start it here, and you pull back to the bottom of the move, and it gives you all these levels. These are supposed to be the Fibonacci levels where stocks are supposed to actually bounce off of, right? But the thing is, this is all, I mean, it's all subjective. Yes, Fibonacci retracement levels, because a lot of traders buy at those levels, prices will often have some kind of a reaction. But it's better, much better to think about it in a more sensible way, rather than mark the 23.6% retracement level, or the whatever it was, the 38.1% retracement. No, the way to think about it is like this. Here's how I think about it. Much more objective, much more reliable, and it's a lot simpler. So you have a stock that rallies, let's say, from here to here. So it moves up like so, and then it pulls back. When it pulls back, we do sometimes see a pause or an attempt to bounce at the 1/3 retracement. So about 33%, about the 1/3 retracement of the prior move. Okay, so that's the first thing to be aware of. Okay, the 1/3 retracement. I guess I went off the page here. So let me redraw this. From here to here is 100%. Oops, I'm going off again. Let's start from the bottom. From here to here is 100%. Back to here is about 1/3. Back to here is about 50%. And then back to the bottom is 100% negation of the entire move. So the 1/3 retracement up here usually fails, because you have a stock that ran a marathon, and we're asking it to go back up shortly after taking a 15-minute break or 5-minute break. So the 1/3 retracement is to be ignored, with the exception being that if the initial move was made up of a wide range bar, it was just an igniting move. It wasn't multiple bars up, 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 and the stock pulls back. It was just one explosion. I need to erase the drawing here real quick and start over. So again, if the initial move was 1 or 2 bars only, then the 1/3 retracement level is okay to play long. You don't actually want to see it pull back to the 20 MA, because if a stock explodes higher, you don't want to see a deep pullback. You don't want to even see 40%. 1/3 is enough for a stock that just exploded higher. If a stock runs up multiple bars, up, 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 like so, in this case 7 bars in a row, or yeah, 7 bars in a row, you don't want to play it shortly after pulling back to 1/3 and then look to play it. It fails almost 100% of the time. Okay? So you don't want to do that. You only want to do the 1/3 retracement if it was made up usually of just one wide range bar, which means it was like a news event or institutional buying right at the open, but it wasn't slow, steady buying that basically exhausted itself. It was just one explosion, and then you can do it off the 1/3 retracement. So that's the only time you want to do the 1/3 retracement. Otherwise, you want to look for the 40 to 60% retracement. 50% is ideal. No, what's ideal? So the question is, what's more ideal? Is it better to stop at 40%? Is it better for the stock to retrace 60%? Does anybody know? What's better, 40%, 60%, 50%? What's better? We said if it pulls back to the 40 to 60% retracement level of the prior move, that gets basically, if you use the ranking system that I teach, that gets 10 extra points. Basically, any play that pulls back to the 40-60% level gets 10 extra points. But the question is, what's better? Is it better to pull back just 40%, 60%? Is 50% the best? What's the most ideal retracement percentage? Does anybody know? Feel free to type in the answer. And the answer is, what's the correct answer, guys? Anybody? The correct answer is, okay, 40, 50, I'm getting 40, 60. Yes, Harry. The correct answer is whatever looks best on the chart. Put the moving average on the chart. You have the 20-period moving average. Where is the moving average? In this case, if it was here, then 60% would be ideal. If 40% would have been too small, right? Would have been not enough retracement. 50% would have been nice, but would still be extended a little bit. Extended means far from the 20. 60% would be ideal. If the 20-period moving average was, let's say, up here, like so, then 60% would have been too much. Remember also, the moving average is usually where the minor support is. So you want it to pull back to the 20 because that's also where the minor support is. Minor support is not a subjective area on the chart. It represents real buying with real dollars, with real money. It represents an area where traders got stuck. And when the stock pulls back to that area, they get the chance to exit at break even. Who doesn't like to get break even when they're down money? Everybody loves it, myself included. If I'm down money and the stock comes back and makes me whole again, great, lovely. So anywhere in that 40 to 60% is great, but usually the right area, the exact right area is where the 20 is at. Okay, so keep that in mind. Then people say, well, what about the, I'm gonna restart the annotation tool. If I use it too much at any given time, it runs out of ink for some reason. What about the double bottoms? You get the pullback, 100% retracement. Can we buy them? And the answer is, what's the answer? Can you buy double bottoms? When can you buy double bottoms? Does anybody know? I just taught you this 2-3 weeks ago. when is it okay to play long at the prior pivot low? Yes, but when is it okay? William is saying when it's a retest. When it's inside of a larger pattern, it's just retesting the prior low, but you have a larger pattern in place, like so, and in this case, it makes for a W pattern. That's an excellent answer. I wasn't even thinking about that. When the prior pivot low, it represents major support. That's exactly right. When the prior pivot low represents major support, then you can buy double bottoms. But most of the time, guys and gals, uh, buying double bottoms doesn't work. Why doesn't it not work? Because buying double bottoms, I'll show you why. Because basically, the stock, here's the double bottom, stock is dropping, here's double bottom, and then slows down a little bit, maybe it bounces, continues lower. A retest of support, a retest of the prior bottom is weak, is a sign of weakness. And stocks usually continue lower. That's why double bottoms don't work. People, novice traders, love buying double bottoms. Does anybody know why? Why do people love buying double bottoms? Because it feels great. Because you're getting the absolute bottom. You feel like you're smarter than everybody else. You got the best price. You go to this auction, or I don't know, you go to this place, they're selling stuff, and you got the deal. You got the best price. That always feels good, right? It feels good. So novice traders always, that's the first thing they do, is they buy double bottoms. And whatever feels good, whatever feels comfortable, never works in real life, but also in trading, right? It doesn't work. The market doesn't pay us to feel comfortable, to feel good, to feel like we're smarter than everybody else. The market actually usually pays you to step up and buy a stock that's really hot, that's making new highs. And that's why buying high and selling higher works better than buying low and selling high. They all say buy low, sell high, buy low, sell high. But if you buy low, you're gonna sell low, you're gonna end up selling lower. Buy low and sell high, buy high and sell higher makes more sense. Because if you buy high when a stock is at the highs, you're basically buying a strong stock. If you buy low, you're basically buying a weak stock. That's not the way to go. Now, I understand there are different investment strategies where Warren Buffett only buys low and sells higher, but we're not talking about trades that take 20 years to reach fruition. We're talking about technical analysis. We're talking about day trading, maybe swing trading. We're not talking about a trade that you're looking to hold for the next 20 years. Okay? So double bottoms usually don't work. All right? With some exceptions, of course. We said if it's at major support. Now you might say, well, what's major support? Does that mean it's like really strong support? If you would like to know, go back and review the lesson from a couple weeks ago. If you're on Facebook, it's part of the Strategic Day Trader Facebook playlist. Or if you're on YouTube, it's part of my playlist, Strategic Day Trader playlist, a couple weeks ago. All right? That's major support. But most of the time, if a stock pulls back to the prior lows, honestly, it maybe slows down a little bit, maybe it bounces a bit, and then continues lower. Why does it do that? Because yes, some traders buy the prior low, and so the stock pauses a little bit, or it bounces even up a little bit, but falls. And the beautiful thing, this is quite nice once you see it on a chart happening live, is after it breaks the prior pivot low, this is the prior pivot low that it broke, let's say, after it breaks the prior pivot low, it often bounces back up, only to fall again. And this is what we call the 110% retracement level. We don't recommend buying the 100% retracement level because that's a sign of weakness. Again, unless we're talking about major support, buying at major support. But the 110% retracement level, you can actually buy. It happens when a stock drops really hard to prior lows and then pauses a little bit or bounces a bit and then crashes below the prior lows. But then what happens is, when I explain the psychology behind it, is I keep having to unfortunately erase and redraw because I can't use this annotation tool too long before it crashes. So what happens is, think about it like this. Why would anybody be still in the stock holding it? Let's say it dropped from 40 bucks to $30 here. Why would anybody be still in it at 31, at 32? I mean, it's dropping and they're losing money. Why would they be in it? They would only be in it because they'd be hoping that $30 holds, right? That's the only reason why they'd be in it if they were technicians. Once it doesn't hold, once it breaks, they get out of it. Okay? And that's the last batch of sellers, the ones that didn't get out here, didn't get out here, didn't get out there, they didn't get out there, and then they still didn't get out here at 32, or once it finally breaks 30 bucks, they say, okay, well, this is it. I held on for too long. I was hoping $30 would hold, and it didn't hold. So they get out. But that's the last batch of sellers. Everybody else is already out. Once they're out, the last batch of sellers, the stock basically bounces a bit because there's no more selling. But don't forget, it retraced 100%. So it's really weak. And so after a 1/3 retracement level, like so, it actually drops again. Does that make sense? And that's precisely why I tell you in the room every day when you ask about this kind of a pattern. You say, hey, Sami, can we buy this here long? And I say, don't, because that's a pullback pattern. Play it here long, hopefully at or near the rising 20. Don't play it like a breakout above the prior high, because you're setting yourself up for that 110% retracement level. You buy it, it pops a little bit, comes back down, you get stopped out, and then goes higher without you. Does that make sense? That's why I tell you not to buy the prior high, above the prior high. Now, does that mean you can never buy above the prior high? You can, but that's only if the stock goes sideways. Then you can buy it as a breakout. When the stock pulls back, you don't want to play above the prior pivot high. You want to play it as a pullback here, as soon as it takes out the prior bar's high. In this area, hopefully again at or near the rising 20. But once it moves up, 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 now it's at 100% retracement to the prior high. Again, anybody that's short is in it short because they were hoping that the high it might hold. Once it takes it out, oops, I'm drawing outside of the window here. Sorry about that. So here's again the prior high, pull back, up, up, up. You don't want to buy it here because usually it pops one more time and then fades. If you buy it here, you're immediately underwater, or shortly after you buy, you're underwater, you get shaken out, and then the play, you get out of it, the play goes up, continues without you. So don't buy it above the prior pivot high if the stock pulls back. The only time to play it above the prior pivot high is if the stock goes sideways, and that's the breakout play. Does that make sense? So again, just to recap, Fibonacci retracement levels have gained mass popularity over the years, but they are subjective. Stocks might often react to Fibonacci retracement levels if a lot of people are looking at these levels and are taking action. But that leads to confusion. There's too many of them. As we saw when we Googled them, there's a 23.6, a 38.2, 50%, 61.8, and 100%. We already talked about when to buy the 1/3 retracement, so that covers the 23 to 38% area. And we already talked about the 50%, and we said it's more the 40 to 60% zone. So we already covered the 1/3 retracement. We also talked about how to deal with the 40 to 60% retracement. And we talked about the 100%, which is usually not playable unless it's major support, or you can ignore the 100 and do the 110. But when the 110% retracement happens, actually it's devastating for both the longs and the shorts, because the longs that went long here get stopped out. The shorts that went short under the prior low, as people often do, they short once the stock breaks support, they get stopped out on the next rally. And then the ones that got back in it long, they get stopped out again once the stock falls one more time. So that's the 110% retracement concept, which is a lot. It's an area that's below support, but usually leads to a 1/3 retracement rally and is buyable if that big sell-off I mean, if that sell-off was pretty big, if it really was pretty big, especially if there's another support area here maybe, or some kind of a like a flat 200 or something interesting about it, then you can actually do the 110% retracement and fade the stock. Okay. All right. Comments, questions, thoughts, concerns, anything at all, let me know. I highly recommend that you don't fall for the hype and Fibonacci retracement levels and things of that nature. Is just hype. Okay, it's just hype. Stick to what's real, stick to what works, keep it simple, don't complicate it, don't draw too many lines on the charts, don't make your charts look like spaghetti charts, noodles everywhere, lines everywhere, right? Question. So don't buy double bottoms unless it becomes major support. And like I said, review the lesson from a couple weeks ago as to when we have what the requirements are for major support. Yes, when it's 3 times, that's major support. But there are other times when one prior pivot low can be considered major support. So instead of me kind of giving you just saying a couple words about it, highly recommend that you re-review the video from a couple weeks ago about major support. Okay. All right. Any other questions? If not, I hope you enjoyed today's lesson. And if you have any questions, please reach out to our wonderful customer service team. They can help you and help answer any questions. If you'd like to, if you're looking for a room, check out the Strategic Day Trader. If you're new, if you've never been part of the Strategic Day Trader, you can get in for 49 bucks. It's as good as free, basically. It's almost free. $49 for 30 days. What I aim to do on a daily basis in the room is to teach a simple and accurate system that's designed to teach you how to trade with a vision that's clear and unclouded by emotions or hype, right? Nothing, everything, I try to keep everything professional about the room. We go over stocks, cryptocurrencies, we cover entries, stops, targets, management, you name it. All right. What else about the room? Well, we are the only room that won the Trader Planet Award for 2 years in a row as the best trading room in the country. This is a fact. It's not a statement to hype things up. That's actually a fact. And once you join us and see what we do, then we challenge you to find a better trading room out there. All right? Check it out. 30 days for $49. Link in the description. And again, thank you for tuning in. Have a nice evening. We'll talk again next week. Take care, everybody.